All right. Good afternoon, everyone. Welcome to our Thursday webinar today. We'll be covering how to properly vet a sponsor. So we'll give it a few more seconds, let everybody get a chance to get logged in here, and then we'll go ahead and get started. Hope everyone's having a wonderful Thursday. It's almost the weekend. All right. We're going to get started. So I'm really excited to bring Josh Ferrari on today. He's our guest speaker. Before we do get started, a few things I have to mention. NewView, we are a third-party custodian. We are a non-fiduciary. It's really up to you as a client to do your own due diligence before you make any investments. So the best way to do that is to speak with an attorney, a CPA, your financial advisor, whoever you need to speak with to check all your boxes, make sure it's a safe investment to make. So with that being said, just want to give you some background on NewView. So NewView's been in business since 2003, 18 years in operational excellence right now, and we custody 1.7 billion under client assets. A few things about NewView: we are simple to do business with, we are available, we are responsive, and we love to build relationships with our clients as well as relationships with other people like Josh, who typically are raising capital, or they have clients that are looking to use self-directed IRAs to invest into different alternative assets. So before we get started, I'm going to give you some information on who Josh is. Josh Ferrari is with Ferrari Capital. He specializes in raising private capital, locating and negotiating and acquiring value-added multifamily assets. And he also teaches others on how they can follow in his footsteps. His ability to manage other people's money as a financial coach positions him to be a high-class asset manager and financial investor. He has raised over $7 million in less than 3 years in real estate investing, and he currently has over 91 units in his portfolio, with another 236 units under contract. And actually, this week he just closed on 88 more units. So it's a little more than what I just read. We got this biography a couple of weeks ago. So he'll give you some more details on his background. So with that being said, Josh, take it away.
All right, man, excited to be here. Thank you for bringing me on, for thinking that I am worthy to be on the NewView webinar. So I'm going to go ahead and start sharing my screen here. We're going to jump right in to what we're talking about today. So he already gave a little bit of intro on me. Everybody, I'm Josh Ferrari. Been in the real estate space for about a little over 3 years, and initially got started in wholesaling. Figured out that didn't really work for me. Then I bought a fourplex, dived into syndication about 2.5 years ago, and have been in syndication ever since, and really have started growing, scaling the business. We've got a team of people now, and we're just trying to be the best that we can be and continue growing the company, helping passive investors like yourself, helping communities, help grow communities, be extremely generous. And yeah, so today we're actually going to talk deeply from a passive investor standpoint on how to properly vet a sponsor. So when you're actually, so I talked a little bit about me. I guess I should have gone to this slide, but you guys know a little bit about me now. We'll bypass that here. So when we're talking about vetting a sponsor, when we're really wanting to figure out who do I even need to give, or who should I give my money to, there's a lot of deals out there. There's a lot of sponsors out there. There's a lot of movement in the space. I personally know, I think maybe it's just me being in the space, but I know a ton of different sponsors all throughout the country. And there are some people that don't really know what they're doing. There are some people that have all the right intent. They want to be the best sponsor that they can be. They want to do right by their investors. They want to make the investment amazing, but they either just don't know what they're doing. They don't have the experience. They don't have the know-how or the bandwidth, because maybe they're not bringing on the right partners, or maybe their partner's going to end up screwing the deal. Maybe this one particular person really well, but you're not really familiar with the partner, but you trust this guy. So you put your money in, then the partner screws the deal, and now you're left holding nothing. So I wanted to just talk quickly about this one particular horror story that I heard. As you can see at the bottom here, I tell the story about the grocery store lady. So I actually read this in a book, this particular example, but I also have a ton. I've heard way too many other examples of folks just investing their money and things not turning out for them well. So the intent of this particular webinar here is to teach you guys what you need to be looking out for, how the fact that the sponsor is a lot more important than the deal, and then how exactly you need to go about vetting them, what questions to ask, what you need to see from them to know if they know what they're doing or not, and so on and so forth. So the grocery store lady, there's this grocery store lady. She worked in the grocery store for a long time, but we'll say 15 years. And throughout those 15 years, she was continuing to save money, to get to a point where she could eventually invest. So then she gets approached, she meets a lot of people at the grocery store. She gets approached by this one particular individual that starts talking to her about syndications. Now, syndications can be amazing, and you can make all this money. And she's like, well, that sounds really intriguing, because I don't want to work at the grocery store for my entire life. I'm getting on up there in age, and I've been able to save a good bit of money. So how about I take some of this money and try to grow it so that I can actually get out of, I guess, in essence, her W-2, get out of this grocery store thing, and then maybe take investing more serious. She started learning a little bit about that, and meeting or growing the relationship with this particular individual. And then she takes all of her life savings. She's like, if I'm going to go in, I'm just going to go all in. She takes all of her life savings, everything she had saved over that 15, 20-year time frame, working at the grocery store, and then even jobs before that growing up, and she invested into this one deal. And then the deal ends up going sideways. Of course, the sponsor, the syndication sponsor that was talking to her, that she was building that relationship with, that she gave her money to, actually ended up being a complete crook and just took everyone's money, didn't buy any piece of real estate, and just ran off with it. I mean, of course, he's in jail now, but she never saw that money again. And so she then was back at the grocery store, working there for forever. At that point, she had to go back. She had no life savings anymore, start from scratch. All the money's gone, all because she didn't fully know this particular individual. She didn't even know what questions to ask. She wasn't super familiar with it. And she took a serious risk by taking all of her life savings and dumping it in there. So all that to say, there are some crooks out there. There are some people that maybe aren't doing it with malicious intent. Maybe they think they know what they're doing. And so you just really need to be careful with who you're kind of giving your hard-earned money to, in order to actually be successful with it. And so that's what we're diving into today. So vet, invest, then rest. I see a lot of people try to do this backwards. They try to basically skip the vetting process, and they just meet someone that says they've got this amazing deal. They're like, hey, you got to get in this deal. You only got 30 days, or you only got a week or 2 weeks or whatever. There's only a few slots. They try to press you with that urgency mindset, and say that it's this amazing deal. You're going to double your money. It's going to be all these amazing things. You can invest through, Newview, through your IRA, and you had no tax implications and this, that, and the other, and all these tax savings. And you're like, oh my gosh, I need to do this. I need to jump into this. This guy seems legit. He seems like he knows what he's doing. And so you dump your money into it, only to find out later that, while you're then going through the process, then you're vetting him, figuring out that his communication's horrible, or that he's a crook, or that he has no idea what he's doing, and the business plan is going horribly wrong. And now you can't rest. Rest has been eliminated because you're too busy worrying. You're too busy freaking out that this guy's taking your money and you can't get it back. It's an illiquid investment. So the idea here is that you need to vet the person. Once you initially meet them, you need to learn more and more about them. Try to learn as much as you can. Try to get as comfortable with them as you can. And we'll dive deeper later here on kind of what specific questions to ask when it comes to the actual vetting process. And you don't have to ask all the questions. I think we've got 72 specific questions that you can actually ask. You don't have to ask all those, but just really making yourself feel comfortable with the investment. making sure that they know what the heck they're doing from that particular market standpoint and X, Y, and Z. Make sure that you vet them properly, then decide what you're going to invest, decide what your actual investment will be, then make that investment. And then at the end of the day, you should be able to rest, because being a passive investor, you don't actually have to do any work other than the vetting and the investing from the beginning. But those are the two most important things you need to make sure, or vetting is one of the most important things you need to make sure that you're doing properly before you do the investing and then the resting. So right off the get-go, do they have a track record? Now, there isn't really much that you can measure in terms of their character and willingness / mindset to achieve success. But without a doubt, their character and your trust in them are probably the two most important factors that you could ever actually look at when thinking about choosing a sponsor. And the saying goes, you need to know, like, and trust the individual. And trust is massive, because you're a passive investor here. So when you put yours, we'll say $50,000 into this deal, you have no say so in the deal. You can't say whether or not, hey, we need to sell it because I need this money back, or we need to sell it because there's this turn coming in the market, the economy is about to go bad, or this is happening over here, or hey, what if we tried renovating on a slower schedule so we can keep some money back in reserves because there's a hurricane coming, or because of whatever, all these worst case scenarios and these different options. And maybe you're more experienced than the sponsor, I don't know, but you have no say so. So you need to make sure that you're 100,000% trusting this person to make those right decisions. I mean, yes, you can email them, you can text them, call them, FaceTime them, meet them up for coffee, whatever, after you've got into the investment and say, hey, this is what I think we should do, or here's what I'm seeing. What do you think? What is your plan to go around this? How can we make this better? Or so on and so forth. But at the end of the day, they have all of the legal rights to actually do any of that or don't do any of that. And they can just take your advice with a grain of salt and do none of it. So making sure that you're truly trusting this individual is going to be massive. And trust, it's one of those things that you can't be like, this is how you trust someone. It's kind of intuitive. And a lot of the questions that I've got set up for you guys to review and potentially ask these sponsors, those are a lot of the questions that I think that you guys will have, or might not have even known that you should ask. But now, knowing once we get there what those questions are, you'll be able to ask them, feel a lot more comfortable, and that trust will really start growing with this potential sponsor that you're going to be giving money to. So then, how do they mitigate risk? We kind of just talked about it in the last slide. It's important to make money when entering into investment, but losing money is probably the biggest thing that I've seen a lot of people truly worried about. And it comes from, say, we'll go back to the $50,000 example. Say you give, I'm a syndicator, I'm a sponsor. So you give me $50,000. The worst possible scenario that I could do is lose your $50,000. Say you invest in a deal and I say, yeah, we're going to double your money in 5 years. Now, if I don't double your money in 5 years, I'm still going to be upset with myself and be like, why did I say I was going to do that? And then not leave myself any buffer or room for error or room for this or that. And like, why did I not mitigate that risk properly so that I could, under promise and over deliver in what I actually said I was going to do? Instead, I've over promised and now I'm under delivering. That's horrible. So obviously I don't want to do that, but I really don't want to say, hey, your $50,000 is gone. You're getting nothing back and you got no returns on your nothing. So like, hey, I've doubled your nothing. That is the absolute worst case scenario. And a lot of people think that, or some folks pay more attention to whether or not your investment is going to actually make money. So you'll see a lot of sponsors pay a lot more attention to the growth of your capital, whether or not it's going to be able to be doubled, what their value add strategies are, how they're going to implement this thing over here, this thing over there, how they're going to do some RUB model on utilities to be able to generate more cash flow for the property, more NOI, so they can do some kind of refinance to get your capital back and X, Y, and Z. And all that stuff's very important. Yes, because when you're investing this money, at the end of the day, you're not investing it so it can just sit there and you get it back in 5 years and nothing happened to it. You want it to grow. So that's important. But I think the more important thing there is how are they truly mitigating risk, especially with COVID-19. For us, when we started, when COVID-19 really started happening, we started underwriting some deals. We were like, okay, what are we going to do to truly help mitigate risk? What are we going to do, not only for our investors' sake, but, for our own sake? We're putting money into these deals as well. So what do we want our deals to look like? How are we expecting the economy to be 2, 3, 4, 5 years in the future? And how can we plan for that so that when we do an investment, we buy an asset, we can make sure that that risk is properly mitigated. And what we've begun doing is focusing a lot more attention on the expense side. So on the income side, one huge red flag that you'll see if you ever got a sponsor that's sending you financials or telling you you need to invest in their deal is the fact that they might have oversaturated or over promised on what the rent growth is going to be. They might say, hey, yeah, in the second, these units are $300, $400 below market. So in that second year, we're going to be at that $400 extra, like premium rent. And we're going to be able to do a cash out refi, or we're just going to go ahead and sell it at that point, or whatever they're saying they're going to do that's going to get you all their money back. But I mean, honestly, I feel like no matter what the economy is doing, do you really think you're going to be able to charge all $400 per unit, per month, per tenant, and get them all to agree, like, yes, in a year's time, when I go to renew this lease or whatever, let me pay that extra $400? Maybe on a new lease with someone new coming in after the unit's been turned, but it's much more conservative to believe that that's going to be drawn out over a couple of years to when you actually get to that point. So what we've decided to do with COVID is we're actually underwriting plateaued rent growth. So say we're $50 a month below market on the actual buy-in for this particular asset. We're going to say, yes, we're going to get that $50 in that second or that third year over the full size, all the units inside of the asset. But after that, we're estimating plateaued growth over the first 2 years. We're not going to go any higher than that $50 because we really don't know what's going to happen. We really don't know if there's going to be a chance to continue to grow. Maybe unemployment's going to skyrocket again, or maybe the economy's going to crash, or the real estate market's going to crash. We have no idea. So we want to play it safe from that regard, mitigate that risk, and say that we're not going to grow anything there. And we paid a lot more attention to the expenses. How can we streamline expenses? How can we streamline property management, utilities, all these different expenses that we have, payroll, so that can basically be our value add. And so that's one way that's one way that we're looking at really mitigating risk in this particular economy, but also just if COVID wasn't a thing, you want to make sure that they are mitigating risk properly, no matter what's going on. So what's in it for them? The third thing you should understand is the incentives of the syndicator and how well they align with your interests as a passive investor. So they should really only win when you win. If they're setting up the structure in a way that they're going to make a ton of money before you ever see any money, then that's probably not the sponsor that you want to be involved with. They are thinking, or they're trying to align their interests and their goals in this deal for them individually way more so than you as the passive investor. Like they're not really focusing heavily on your interests, and so that definitely might not be something that you want to dive into. And so maybe they are going to take a massive acquisition fee. Maybe right off the get-go, they're like, hey, we're taking a 5% acquisition fee. There's going to be no preferred return, which is just a fancy word for interest rate on your money. And the split's going to be like 60-40, where the GPs get 60%. And you're like, well, this sounds like a horrible deal. Why would I invest in it? And it's because they've incentivized themselves more heavily than you. But also, sometimes you have to really dive deep into the intricacies of the PPM and how they're actually going to be operating or structuring this particular deal, because sometimes it might not be that obvious. They might have that 70-30 split where 70% is going to the passive investors like yourself and 30% goes to them, and they're only taking a 2 or 3% acquisition fee. Maybe they're not even taking an asset management fee or whatever, but maybe there's a capital transaction fee in there somewhere that's like 3, 4, 5%. And it happens every time they refinance, and they plan on refinancing like 4 times in the 5-year hold that you have. And so they're basically trying to squeeze all the cash flow and capital out for themselves. And meanwhile, you're just looking at the numbers, and maybe you bypass that number. Maybe you didn't fully understand what that capital transaction fee was, and you're thinking you're going to make a lot more money than you actually are. So that could be something that is not truly an incentive for you as the passive investor, but is a high incentive for the syndicator. And that's just one of a million examples. There's also other things where they could use any excess cash flow to pay your capital back. So let's say they might tell you, hey, it's going to be a 70-30 split. It's standard 5-year deal. You're going to invest your 50,000, and we're going to give you an 8% pref year over year on your money. So with that 8% pref, say you invest the 50,000, I'm horrible with math, so we'll go back and say it's a 10% pref. So we'll say you're supposed to make $5,000 year over year on your money. And then anything over that is going to go to a return of initial member capital. So when you actually look at the financials, you're going to think that you're going to be making a ton of extra money because you're thinking it's going to be all this excess cash flow. And they're like, yeah, you're going to get $10,000 the first year and $20,000 the next year. And, it's going to be great. Continued growth. It looks like you're going to make a ton of money. But actually, everything over that $5,000 is going towards paying you back your money. So instead of actually earning anything on the money, they're basically buying you out of the deal. And it's not always bad. Sometimes folks can try to buy you out quickly, or I say buy you out, but sometimes it's not always a buyout. They can try to pay you back as quickly as possible so that they can get rid of the pref or split the cash flow some way. And I'll have to say it's not necessarily a bad thing if they're trying to pay you back, but if it's something you didn't know and is directly incentivizing the syndicator and not use the passive investor, then that's also something you might want to pay more attention to and think, well, why are you doing this? This doesn't align with what I'm doing. So maybe they're not the right person to invest with. And sometimes the syndicator might be a great syndicator. It might be a great sponsor. And maybe you've invested with them before, but they've got this one particular deal that just isn't right for you. So not every deal that particular person does is going to be right for you. The timing might not be right. The deal might not be right. Structure might not be right. Market might not be right. Economy might not be right for your own risk mitigation. And so just making sure that you also understand on your end what your incentives are, what you're really trying to accomplish with this investment will help you understand if their incentives are aligned with yours. So how to get these answers? How to figure all this out? What if you have no idea what to ask? What if this is your first time actually trying to invest in a syndication? And hopefully you trust your syndicator and they've answered all of your questions, and that they have basically taken what I'm about to show you and answered a lot of the questions that you didn't even know you needed to ask. Hopefully they are making conservative projections. Hopefully they are doing all of the things that need to be done or need to be seen in a good sponsor or a good deal in order for it to be incentivized for you and the risk be properly mitigated and all of those things. Hopefully they're already doing that before you ever even have to dive into answering these questions yourself. But if not, then that's why we're going to review these questions. You need to know what questions to even ask so you can actually get these answers if they haven't directly answered them for you. And if they kind of give you some pushback or some feedback, like, I don't think I need to answer all those questions, or maybe they're not even going to be so blunt with it. Maybe they just say, hey, well, I don't really have time to answer a lot of these questions. Are you in or you're out? I would just say I'm out. If I were you, be like, well, then if you don't even have enough time to answer any of my questions and I'm trying to give you $50,000, $100,000, then you're not going to have, you're obviously not spending the time or have the right mindset or have even analyzed this deal properly to know that it's going to make sense. So I don't want to invest with you. You're not going to be the individual that I give my money to. So making sure that they're giving you a lot of time, making sure that the communication is great also. And that's something we'll we'll dive in here on some of the future slides. So I actually got 72 different questions here that you can potentially ask your sponsor or your syndicator, or a potential individual that you're building a relationship with who is a sponsor and they've got some deals, but excuse me, maybe they're all 506B. So you actually have to have a pre-existing relationship with them before you actually see any of the deals. So you're trying to create this bond, you're trying to create this relationship, but you don't know what to ask. As far as like syndication specifically goes, you know how to create a relationship, you know how to chat with the guy or gal, but you don't really know what to ask. So we're not going to go line for line over every single question, but I'm going to give you just a brief synopsis of some questions to ask in each slide, that you can use to ask these sponsors and to learn the things that you need to learn. And hopefully you can actually get this actual presentation afterwards and use it as somewhat of a template, because all the questions will be on there. You'll be able to use it as a template to see and know what questions to ask. And you could just honestly copy and paste and say, hey, I want to know all these things. And they'll be like, oh, wow, this person knows what they're talking about. Maybe they got a ton of money, or maybe, whatever. But hopefully they take the time to actually answer these questions. They take the time to know you, learn about you, and truly have your best interests at heart. So first off, the team. You want to know how their roles are delegated. Who's responsible for the various disciplines? Some examples of roles, for those of you that might not know what some of the roles even are in a massive syndication. You got acquisitions, due diligence, equity, debt structuring, entity and transaction, legal, insurance, accounting, asset management, property management, investor relations, investor reporting, and tax masters. Those are just a few. That doesn't even cover everything. And I am primarily investor relations on my own team in Ferrari Capital. And so I deal with a lot of the capital raising. I deal with a lot of the actual putting together the investor offering packets that the end investor will actually get to look at, review, and see, decide if this is a deal that they want to do. I handle all the investor portal information. I handle all of the K1 distributions. I handle all of the communications, the overall building connections and relationships with people. And then I'm also the marketing kind of manager. Deal with some of the insurance. I deal with some of the legal stuff. We do a little bit of everything. We haven't really zeroed in on exactly what all of our roles are, but all that to say, those are some of the roles. Those are some of the things you want to see who's doing what. And then does that actually go to the strength of that individual? Say they're doing investor relations, say they're raising money, but they're horrible at communications. Like every time you email them or you try to schedule a phone call with them or whatever, they're unreachable. You can't contact them. They don't ever respond. Is that really the person you want dealing with the communications in that? Or say they're handling the property management or the asset management and they've never managed a deal before in their entire life. This is their first syndication ever. They have no idea how to manage anything. Is that really the person you want in that role? So then you got who's providing the loan guarantee, how long the partner's been working together. You really just want to know overall the team. Is this a really great team that I'm investing with? You not only want to know the main person that you have begun building a relationship with, but you want to know their partners as well, and what their roles are, what they do, whether or not that they all kind of jive and make for a good team. Are they successful? Have they done anything before that's successful? And then are they the right person for that job? So next you got their experience. That is, have they done this before? How long have they actually been investing in real estate? Maybe not even specific to multifamily, but how long have they reviewed or done, say, single family flipping? How long? So they could technically been managing assets, managing the construction. They've been in the game for a really long time. But then also you do want to see, especially in syndication, if do they have any experience, and if they don't, that's maybe not necessarily a deal killer, because everyone's got to start somewhere. And a lot of people that are trying to start, I know a lot of people trying to start right now, and maybe they don't have that experience, but maybe they have a teammate that has that experience. Maybe they're kind of able to pull some of that credibility from someone else, pull that that overall experience, so that if worst case scenario happened, there's at least someone on the team that has that track record or has capital to back something up, is liquid, that so that they can pay for an insurance claim when a hurricane hits and destroys the whole property, or fire uproars, or the economy twists, or the whole property goes vacant because of some other black swan anomaly that isn't COVID. I don't know, but do do they have anyone that has capital experience and knows or has done these things before? How many properties has the team acquired as a whole? They only done this one singular time? Have they never done this before? Or have they bought thousands and thousands of units, and you've got a lot of experience and track record there that you can look at, review, and potentially even other investors that have invested with them that you can ask, you can talk to, and you can see if they know or if they've had a good experience with that particular sponsor. So then that particular geographical market, how long have they been, say they're trying to invest, I'm down here in Mobile, Alabama. Say they're trying to invest in Mobile, but they've only ever invested in California before. And they're based out of California. So why are they suddenly switching all the way to Mobile? This is thousands of miles away. They're not boots on the ground. How do I know they're going to be able to properly manage the asset if they've never even been there? What's their plan there? So things of that nature, those are some of the questions you want to ask about their particular experience. Then their experience continued. We kind of went over a lot of things. So this is just a ton of more questions. What was their worst deal? How did they overcome that challenge? If their worst deal was that they lost all their investors' money, or that they thought they were going to, the economy tanked. And so they were like, well, we were supposed to sell, or we were going to refi right now, but instead we're just going to hold on to it. We're going to play it safe. We're going to keep some capital in reserves. We're going to try to wait out this big dip here so that we can eventually get the refinance. We can eventually sell and get you all your money back. Yes, it's going to be longer than we initially had projected, but we're not going to lose your money. We're not going to do anything unnecessarily risky. So that might be a good sponsor. Yes, they had that horrible deal, but maybe it was something that they couldn't control. And so they did what they could do. They controlled what they could and tried to make it work for the best interest of you as the passive investor. So we'll go ahead and go on to the next one. Relationships. How do they source their acquisitions? How do they source their debt and their overall lending relationships? Figuring out, where are you finding these deals? How do I know that these deals are actually good? How do I know that you're not yet finding these deals from Joe Blow off the street that sent you something saying, hey, this is a great deal? To go back to the scenario about the investors from California investing in Mobile, how do I know it wasn't some random person in Mobile that called them up because they've seen them all over social media or seen their website or something? It's like, hey, I got this awesome deal down here. Look at these great numbers. And they just look at it, immediately trust this random dude and decide they're going to invest in this deal. But the deal is really not that great. So knowing how they're actually sourcing their acquisitions, is this a reputable broker? Is it not a reputable broker? Is it someone that screwed folks over before on deals? Then how are they sourcing their debt? What does the debt look like so that you can truly be able to mitigate some of that risk when you jump into the deal? Due diligence, very simple. Ask them to explain their due diligence procedures. There's a lot of different things you can do due diligence. There's a lot of different ways you can do it, but primarily here, we'll say you've got the due diligence process getting ready to start, and they're getting ready to do their walkthroughs of the property. We use the most recent deal that we just got under contract. For an example, we just got an 88 unit under contract. So let's say this is an 88 unit you're looking at investing in, and they're getting ready to begin inspections and their walkthroughs to see if there actually is any issues in any of these units, and if the seller's explanation of the condition of the property is actually true to its word. And so let's say, well, they're thinking, we don't really need to go in all the units. We'll just go in a handful of them, or we'll just go in the vacants, and the vacants will tell us what the others look like. And, or if there's a 1 bedroom, 1 bath combo and a 2 bed, 1 bath and a 3 bed, 2 bath, let's say we'll go in one of each type of unit. We'll see what it looks like. And then from there, we'll be able to know 100% what all the rest of the 88 units look like, and what the condition is, and how we need to renovate this. That's probably not the proper due diligence that needs to be done. This is 88 units. And if they're only walking 3, then the other 85 units could be in utter shambles. I mean, they could be gutted for all you know. They're telling you they got these renters, but maybe they just placed fake cars in the parking lot and took pictures of it and said, hey, look at this great deal. I don't know. I haven't seen that happen, but I feel like it's probably happened at some point. And all the units are gutted. I don't know. You really want to make sure that they're actually walking all of the units. that they're really doing proper due diligence to be able to fully mitigate the risk and understand what they're getting into, as well as what they're potentially getting you into by bringing you on as an investor. Next, we have reporting. So, who performs the accounting function at their organization? Maybe this particular individual or this particular company has an accountant that they've hired, and maybe the accountant has no idea what they're doing, or they haven't hired a legitimate accountant and they're just trying to do it themselves. And they have no idea what they're doing. They have no idea all of the different intricacies and ways that you can play with the numbers there to really get the best NOI, and be able to kind of offset a lot of those expenses so that the value of the property can be where it needs to be when you actually need to do the refinance or when you actually need to do the sale. So maybe their accounting is horrible. Maybe they have no idea what they're doing with the accounting. So making sure that you know that their accountant knows what they're doing, maybe even getting some reports that accountant has done before, if they actually have one. What accounting experience does that person possess? Ask them to explain it. Then quarterly reports. That's another thing. So quarterly reports, online investor portal, K1s, all that stuff. I think the big thing there is how soon are they sending out their K1? So the K1 is basically just a form that you're going to get, an annual form that you're going to get based on how that particular investment did and how that particular property did, that you'll file in your taxes. And so us as the sponsors, we have to provide those K1s to you guys as the passive investors. And so are they delivering this K1 in like April or May of that year? And you're like, bro, I've had to file all these extensions on my filings because you're not giving me the K1. Like, why didn't we have this back in February or back in January when it had been a month or two since everything had been finalized? What's taking so long? Why are you not getting me my K1 when I need it? So making sure you know when they typically deliver those, what that time frame is, and then the investor portal, which is just an easy website basically for you to go onto and have those up to date, progression of how your actual investment is doing. So again, just making sure you know how their reporting works. So property and asset management, who's going to be managing? Is there a third party company, or do you guys actually have a property manager in house? Are you vertically integrated to where you have a property management company that is working for your company, or that is a part of your company that is actually going to be managing this property? What is their experience? What is that particular manager's experience from a property management aspect and an asset management aspect? So more often than not, you're going to see the sponsors actually become the asset managers, and that's where the asset management fee comes from. So that could also go back to their experience. What experience do they have? How many units are they managing now? How many units do they or have they managed in this area? So primarily, we're really discussing here what the property management's going to look like. Maybe they're bringing on a new property manager into the deal that doesn't even own any units in this market. They have no experience in this market. How the heck are they going to know what rents to bump to? How do they know what market is? How do they know anything? How do they don't have a relationship with anyone? Do they have any contractors? Because maybe you're relying on them for the CapEx. Does this property management have any connections to any contractors? Well, I don't know. Do they? And if so, are those contractors any good? Do they have these connections with Joe Blow and Sally Mae over here that are just trying to make ends meet, but really don't care to do a good job? So figuring out all those things, property management specifically, are you really going to be able to execute on the business plan, not only from an asset management standpoint when you're vetting the sponsor, but also a property management standpoint? Because at the end of the day, the property manager is going to be the one that's on site day in and day out, really making sure that this property is running properly, and keeping, most of the time, the property manager actually does the accounting as well, or at least the initial accounting. So making sure they know what they're doing on that front too. Capital improvements is a renovation budget based on contractor bids, their past experience, or just a wild guess. So CapEx is usually huge. A lot of syndicators, a lot of sponsors, they like to buy what most of you have probably heard of, a value add deal. I think value add is one of the most overused terms in syndication, but at the end of the day, that's what it is. So how are they truly adding value? What is their plan? What is their business plan? How are they going to execute on that? What does the budget for that look like? They're saying that's only going to cost $200,000 to redo all the inside of 88 units and get new roofs and get new siding and do all these things. And maybe you just have no idea what it's actually supposed to be. So diving deeper into asking them about how they came up with that number. And if you can tell, they also don't know what they're talking about, or that they just guessed on it, or they try to give you some mumbo jumbo about how they got these contractor bids, then you need to also maybe even go further than that and talk to those contractors and see, well, hey, do you know what you're talking about? Show me some experience that you've had on replacing a roof. Maybe they got this roofer that quoted them $5,000 to replace like 5 roofs, $1,000 a roof. And you're like, that doesn't seem right. That seems extremely off. And it's because they have no idea what they're doing. The contractor is going to do an extremely shoddy job. And you're honestly better off keeping the old roof than getting this guy to tear it off and try to replace it with his version of a new roof. So they're only estimating it's going to cost $5,000 to replace all these roofs, when really it's going to cost like 50,000 or 100,000 or whatever it is, from an actual reputable contractor, someone that knows what they're doing and can do it in a timely manner. When it comes to capital improvements, a lot of folks, sponsors specifically, are stating that, hey, we're going to get all these renovations done in the first year. By that second year, we're going to have a refinance. Well, how are they really going to do that? What is their actual plan for accomplishing all of those capital improvements? Or maybe they're telling you they're going to get it done in 2 months when it's really going to take 6 months, 8 months, 2 years. And so just learning, kind of understanding a lot of those things, asking those questions, that'll help you build a better understanding and an overall trust of whether or not they know what they're talking about and whether or not they're really going to be able to execute on that capital improvement business plan. Next, you got cap rates and valuations. This is, what is the market cap rate for similar properties in this area? And cap rate's one of those things that can kind of get really confusing. I don't like to use cap rates too much. I think because a confused mind always says no. So I think it just confuses a lot of people. But if you're really into cap rates, if you really are deep into this space and you understand a lot of those things, then understanding what the market cap is, maybe they're telling you, hey guys, we're buying this deal at an 8.5 cap, but that particular market, the only deals that almost everyone's been able to find and kind of what market rate's been has been, say, a 5 cap or a 6 cap. And you're like, well, how on earth are we buying at an 8.5 cap? Let me look at your numbers. Let me make sure you know what the heck you're talking about. Is our purchase price, how are we actually getting this deal under contract? Is this a legitimate deal? Is it too good to be true? More often than not, when they're telling you they're getting an 8.5 cap when the market's 5, it's probably something you want to dive a little deeper into, because they're probably also estimating that at the exit, the cap rate is going to be lower, because the higher the cap rate, the better for the buyer. The lower the cap rate, the better for the seller. So when they're actually going to sell it, they might be saying, hey guys, we're going to be able to get a 5 cap on the sale, even though we're buying at a 8.5. And you might say, well, are you sure? Is there not going to be any adjustments in the market? Is this particular deal maybe just never going to see that market cap because of its asset class or its location or the condition of the actual property or what we're actually going to raise rents to? Are we ever actually going to be able to see that cap? Would it be more conservative to have a little higher of a cap there on the sale, so that worst case scenario, we're still able to at least get, we'll say double in your money, or whatever the initial projections are. You don't want to project something astronomically like, hey, we're going to quadruple your money in 5 years because we got this awesome cap rate. A lot of times that's all it takes. All the numbers can make a ton of sense. You can look at all of them. You can review them. You can talk out of the contractors, the property managers. You can do all that stuff and be like, this really makes sense. This seems like a screaming deal. But it could just be that one number in their analyzer of the cap rate being a sale of a 5 cap when they bought at 8.5. That can be the difference between quadrupling your money and just doubling your money. So making sure that you're paying attention to what cap rates they're estimating is extremely important. So sponsor capacity, what happens if they don't close? What will they do if they only raise half of the money, can't raise the other half? Really figuring out what their bandwidth is. Do they already have 17 other deals going on? Do they actually have the capacity to close this one? Is there any risk of loss of any or all of your investment if they can't complete the fundraising? It's a really good question to ask. I honestly didn't even know to ask that question until I stumbled upon this question in my research and was like, wow, Never even thought that is something that sponsors are doing, that they're potentially taking all that money if they can't complete the fundraising. But I guess it's happened before, and that's why it's a question. So making sure that you understand, am I just going to get my money back if you can't complete this investment? Or are you going to try to make me pay for due diligence if the deal fails to close? For all of the capital we put out here henceforth, or the EMD, are you just going to use my capital as collateral and say, well, deal couldn't close, but I'm not losing any money. Sorry, you lost out on money. Just making sure you know a lot of those things from a sponsor capacity perspective will also help you. So alignment of interest, we already talked about this. Who's signing the loan guarantee or carve out guarantee? It just goes back to the question about is the alignment of interest similar between you and the active sponsor in the deal? Does the things actually line up and make sense? Are you benefiting before they're benefiting, or vice versa? What does that look like? And then the loan guarantee or the carve out guarantee here is just who actually has the liquidity, the net worth, the experience to sign on the dotted line. How much are they actually getting to do so? And now that they have signed on the dotted line, they have guaranteed the loan, they're now a GP in the deal. They're active. So they have say so. They have ability to change something. So it just goes back to the team aspect of making sure you know everyone that's on the team, what their roles are, whether or not they play a good role there, what that's going to look like, so on and so forth. Next, we have exit strategies. What are their exit strategies? Does the loan have a large prepayment penalty that they have not underwritten for in their analysis? Are they basically stating that you're going to get all this money in the third year? Say they've got this 5-year term thing, this 5-year term agency debt, and it's got a prepayment penalty of say 5, 4, 3, 2, 1, but you don't know that, and so they're telling you that in the third year they're actually going to sell, and that's when you're going to be able to double your money. Everything's going to be great, hunky-dory, fantastic. But in actuality, you're going to get charged with that 3% prepayment penalty, and that might be pretty large. Or there might be some yield maintenance there that might be pretty large, or there might be a huge tax hurdle or tax something that you have to pay for, tax recapture that you have to pay for when you sell so soon, or when you sell with the prepayment penalty there, or whatever it is. Making sure that you understand those things, as well as making sure that you understand that they have, or they should have, multiple different exit strategies, especially during COVID. They might be underwriting a 5-year hold, but is there also a possibility that we might hold longer? Is there a possibility that we could sell sooner and still not lose any money, or still make what we were expected to make? Or if we do hold on to this because the economy tanks, am I going to start having to dish out money? Is there going to be a capital call? What would our worst case scenario exit strategy be? Making sure you understand all those things. What is the plan if there is an adverse market cycle when it comes time to sell? Are they just going to go ahead and sell and cut the losses, or are they going to hold on to it and wait out the market cycle so that they can still make sure that you get the returns that were promised? It just might be a little bit longer than expected because of that unforeseen there. So making sure you understand that. Underwriting projections, we talked a lot about that, making sure that they're underwriting, or are the forecasted returns gross or net? What are the terms of the loan? Are there any prepayment penalties? We kind of discussed some of that, making sure you really understand that they're not kind of pie in the sky telling you that you're going to make all this money and really they have no idea what they're talking about. So diving deep into those financials, understanding how they're coming up with the numbers that they're coming up, what that looks like, that'll help you in the long run of just being able to underwrite deals and understand what other sponsors are forecasting, but also understand if this particular deal might be right for you. Waterfalls, is there a waterfall? After you give me all my money back, in that example we talked about earlier, where you get that 8% pref on that 50,000, but they're returning all of initial member capital back to you, anything over that 8%. After that, is there a waterfall? Are you going to invert the cash flow on me? You're going to buy me out completely, and once you've returned all my money back, I have no more money in the deal and get no more benefits at all? I'm just gone. That's the waterfall. Or are you going to start paying yourself a lot more money and not me, due to some kind of waterfall you have in there, or whatever? Making sure you fully understand the structure. And if they tell you there's a waterfall, really, really understanding what that waterfall looks like and what that is going to mean for you and your investment in this particular deal. fees, making sure they're not charging outrageously ridiculous fees, because most ways that most sponsors get paid is an acquisition fee, an asset management fee, equity that they actually have in the deal, and then potentially a capital transaction fee. I'm sure there's some other things out there, but those are kind of some of the general fees that are paid. So our company, Ferrari Capital, we don't charge any capital transaction fee, but we do charge an acquisition fee and we do charge an asset management fee, and then we get a little piece of the equity. So making sure you just understand what those fees are, what that schedule of payment's going to look like. Are you going to get your asset management fee before I get my preferred return? If there's a shortage in this one particular quarter or this one particular year from distributions, are you going to take your asset management fee and I'll just be shorted my preferred return, or am I, as the passive investor, going to get my preferred return before you get your asset management fee or your excess cash flow or whatever? Kind of what is that? Which goes back to the waterfalls. What does that look like? That overall payment structure look like? So making you understand that. And then lastly, reporting. Again, due to its importance, how often do they report to their investors? Communication is key, even if they're just communicating with you to tell you that there's nothing to tell you. That everything's going well. There's no new information. Nothing horrible has happened. Nothing catastrophic. Just as long as they are communicating with you, and then really when it really shows whether or not this particular individual is a good sponsor or can handle the upset or whatever, is deciphering or figuring out whether or not they are communicating with their investors in the bad times, when things are taking a turn for the worst, when you realize there was a hurricane that just came through the city that you had a property that you invested in, and 2 weeks goes by, 3 weeks goes by, 2 months go by, 4 months go by, and this sponsor has not communicated with anyone and said anything to anybody about the fact that a hurricane did or didn't hit the property. What were the repercussions there? What was the damage? What's going to be our deductible that we actually have to pay for the property to get it back up to par? Is the insurance company actually going to pay out what's needed to get it back up to par? Are we just going to have to cut our losses? Like, you need to understand all of this stuff. They need to be communicating with you and letting you know and updating you with everything that is happening. So, for your own, well-being and for your own peace of mind, if nothing else, but also just because it's extremely important that you guys be in the loop and understand the ins and outs of what's happening, and so that you can just be up to date, really, and have that peace of mind. So that's really it there. And then lastly, we got the summary here. That's 72 potential questions that you can ask a sponsor to properly vet them. I hope you guys have gotten a lot out of this. As you can tell, vetting your sponsor is extremely important, and there are a lot of things that you should know before making the leap. So I hope I've been able to help you guys a little bit here, show you the importance, and hopefully provide some good resources for you to go out and start doing your own vetting to some sponsors. Maybe you haven't done it before. Maybe you have, and you had no idea you should have asked these questions. And maybe you don't need to per se, but for your own comfort, that's something you can do. And so I know we're about to jump into Q&A, but if anyone would like to learn more about this topic, still has questions, feel free to go on our website, ferraricapital.com. You can figure out all the ton of information on there, ton of resources. You can also schedule a call with me there, or you can just email me at joshferrari901@gmail.com to learn more about me as a sponsor, or ask me some of those questions or whatever. So I'll hand it back off to Brian here.
All right, Josh. Hey, that was a great presentation. A lot of great questions to ask if you're trying to vet a sponsor. I love any presentations on due diligence, and that's a very thorough list of things to ask that a lot of them I didn't even think of. So this is going to be really helpful. One of the first questions I have here is this list going to be available? Do you have it like in a PDF version that we can maybe send out to the people that registered?
Yes, I do have it in a PDF version. I can shoot that over to you once we get off here, and then you can email that out to whoever signed up for it, or
Awesome.
we can post it on social media. Like, it doesn't matter. It can be wherever for everyone to see.
All right, that sounds good. Yes, this recording will be available. We'll post it on our blog by the end of business day tomorrow. So if you want to revisit it, you feel free to click the link. It'll be at the top of the blog section. All right, so we have a few other questions here. How would somebody go about finding these good sponsors?
A good sponsor. So finding them, I think, just comes with overall putting yourself out there, building connections with folks, creating true, genuine relationships. A lot of times you might get on the phone with folks. I don't know if you guys have experienced this, but me being investor relations, I experience this a lot where folks will contact you, say that, hey, love to stay in touch, love what you're doing. This is amazing. And then you never hear from them again, ever. And it's like, well, what the heck? Why'd we even get on the phone in the first place if you don't really care to learn more about me or what have you? So I think really creating a true genuine connection, making sure that individual is actually reaching out to you, or you're reaching out to them if you're really wanting to learn more about them, and building that relationship. So once the relationship is built, even through that, you could be potentially asking some of these questions from just a sheer curiosity standpoint without even considering investing in a deal. Maybe they don't even have a deal available at that time. Just asking them, hey, is this something you've done before? What would something like this look like? And if they're really open to asking or to answering a lot of those questions for you on this phone call, the Zoom call, or if they're readily available, I think those are some ways that you'll be able to figure out, okay, this sponsor is a little better. But then also referrals. I think referrals is massive. If you've got friends or family or colleagues or whatever, coworkers that have invested with a potential sponsor before, if they're telling you that this sponsor is amazing, like the communication has been great, the investment's been great, I've invested with them like 4 different times on all these different deals, they've like tripled my money when they said they were only going to double it every time, then that's fantastic. Maybe don't take them by their word, but the fact that they've referred this particular individual, they're probably a really good sponsor. And so you should reach out to that individual and see if that sponsor is someone that you might be interested in investing with.
All right. We got lots of questions here for you. Okay, the next one. Have you ever suspended investor distributions?
We have not ever suspended investor distributions. I can see why that would be a question or why that would be a concern. Depending on what's going on, maybe the deal didn't do well that particular quarter. We usually submit distributions every quarter. And so maybe you needed to hold back some for reserves. Maybe you didn't get enough money in, or COVID was making sure that tenants weren't paying. And because of that, you thought you needed to set a little bit of aside for reserves. So maybe you held back some of those returns. We have not actually done that. We have had to hold back our asset management fees before in order to give our investors their preferred return, which for the most part is either 8 to 10% on average on the deals we're doing. So make sure that they're getting their 8% preferred return for that quarter. And then any extra that, or the asset management fee that we were supposed to get, plus any extra that we might have given out, we might not distribute the excess cash flow, plus not take our asset management fee. We might keep that money inside that particular account to hold it as reserves, kind of build that reserve account back up just in case we had to deplete it that quarter for whatever happened.
What asset class of assets of apartments do you guys focus on mostly?
We're primarily focused on B2C class assets, kind of a lot of the things that you hear most folks interested in. We're in the markets of kind of the southern Alabama region down here in Mobile, Alabama. We also cover a little bit of the northern Florida panhandle. We got a partner that lives over in Destin. So we like to say that we go from Panama City all the way west into southern Alabama, but we haven't found any deals that really penciled out for us in the northern Florida panhandle. So all of our portfolio is actually in the Mobile, southern Alabama region. That's where we found a lot of success in those BDC class assets. We've even invested in some deals that were kind of on the outskirts of the MSA, little town called Citronelle, about 20, 30 minutes north of Mobile. I'm smiling because it is actually one of the better deals we've done. So it's just funny that it's population 6,000 people, and it's one of the better deals we've done. So to answer your question, it is B2C class. It's roughly about 30 to 150 units is roughly what we're targeting right now. But yeah, that's pretty much what we have in our portfolio, as well as what we're targeting in the future.
Have you had IRA investors invest with you, and do you fill out the fair market value forms for them?
I can't say that we have filled out any of those for us from an IRA investor perspective. All the IRA, yes, we have had a ton of IRA investors invest with us, but primarily they have their custodian do a lot of that stuff for them. So we do have a lot of IRA investors. We're very familiar with the way that the system works and how we need to make sure that we go about the paperwork and the distributions, that the money has to go into the IRA account and you can't actually see that money. We got all those things, all those systems kind of built out there, but no, we don't. We don't fill out that piece of paperwork you mentioned.
You provide them the K1s though, correct?
Yes, we provide all of the K1s. Every year we like to get them submitted and sent out to you guys by February. But this past year, or the beginning of this year, we weren't able to get our one of our deals K1 sent out until March because we did a cost segregate. We closed on the deal December 30th of 2020. So as soon as we closed, that was when we executed on our cost segregation study. So the cost segregation study took a little bit of time, and then we needed that study to be finished before our CPA could input all that information and get all the K1s right, so that our investors could get the biggest benefit from a tax perspective from that accelerated depreciation on their K1. So it took a little bit longer to get those, and we ended up submitting those in March. But we do like to have all of them submitted by February on average.
The property management team that you use, is it in-house or is it a third party?
We don't have any in-house property management. We actually use, or we have used 3 different property management companies on 3 different deals. And it's not because we don't trust one particular property management company or because we think that they can't handle it or that their bandwidth isn't there. It's none of those reasons. Primarily the reason that we've done this is because, yes, we are in this one particular market. So one particular property management company could have handled it all, but we really wanted to get a feel for how some other property managers ran their company, ran their business, what their systems look like, what their processes look like, how well they were actually able to run this asset, how well they were actually able to bring up rents, get tenants out, run their actual accounting, their reporting, how well their communications were. We wanted to see all those things so that at one point, say 2-3 years down the road, we can decide, okay, this one particular property management company or these 1 or 2 have been absolutely amazing. So we're going to use them 2 on every deal henceforth. And we might even fire one and have them overtake one of the deals we already have.
All right, Josh, I think that's it for the questions, but I really appreciate you joining us today. That was really valuable information. That was a great checklist. I know a lot of people definitely be reaching out to you for this list. We'll blast out to the people that did register. Anyone that didn't register, this will be posted on our blog. Feel free to share the link with anyone in your network that wants to learn more about how they can vet a sponsor before they invest into any deals. And before we go, the first 10 people that reach out to me, and that is my direct contact information, we will be waiving the $50 application fee. So the first 10 people that reach out, and you can call 407-708-1853, or you can email me at info@newviewtrust.com. Once again, thank you for joining us, Josh, and we'll have to bring you back again in the future.
Yeah, absolutely, man. Glad I could be a part of it.
All right, everyone, have a wonderful rest of your day.